What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. This past week has been one of the most insane news cycles that I've experienced since at least the early days of the COVID-19 pandemic, where fear was spreading faster than the virus itself. There was an overnight explosion in Twitter accounts claiming expertise in epidemiology, and yet no one quite knew what to believe about anything. I kept thinking back to my conversation with John Askinas about the fragmentation of the media ecosystem and what it means in practice when a society loses its ability to form consensus truths in the context of last week's events. While the impact of this dynamic on government policy is not the focus of today's conversation, it is an important backdrop that I want you all to keep in mind going forward as we sort through the news cycle together and try and make sense of events as they unfold. The reason I asked Jeff Snider to come back onto the podcast today is because he has been ringing the alarm bell in anticipation of a panic-inducing event like the bank failures we experienced last week for more than a year. In his last appearance on the show, he pointed to what he called a, quote, increasing sense of dread that he felt was reflected in credit and derivatives markets. That market participants, in other words, were hedged for something, perhaps even a deflationary event in the monetary system, like a bank panic that would lead the Fed to prematurely pause its rate hikes and possibly even reverse its policy entirely to stave off another financial crisis. Whether or not the Fed reverses course this week is less important than how the system itself, the banks, brokers, and other financial intermediaries who make up the international financial system, change their own behavior as a result of recent events. What this means for asset prices, the prospects for economic growth, inflation, and government policy are all topics that we explore in depth during today's episode. In the second hour, we zoom out to look at the bigger picture, specifically what the system itself ends up looking like coming out the other end of this crisis. Do we get more consolidation, centralization, and government control, or is there a path to something else? And how does the international security environment make today's crisis and its potential resolution look very different from what we experienced in 2008? If you want access to that part of the conversation, and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second half of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. And with that, please enjoy yet another awesome and extremely timely episode of Hidden Forces with my guest, Jeff Snider. Jeff Snider, welcome back to Hidden Forces.
Hi, Demetri. Thank you for having me back. I really appreciate it.
It's great having you back on, Jeff. You're at the very top of my list of people to have on the show, especially after a crazy week like this. Before we start, I want to mention to listeners that I'm hosting a live video Q&A with you and Brent Johnson for members of our Hidden Forces Genius community on March 23rd at 5 p.m. Eastern Standard that I am opening up to anyone who wants to join. So if you're interested in joining that call and getting a better sense of what these Q&A calls are like, you can do that using the RSVP link in the summary section to this episode. Also, I want to encourage people who haven't heard your first appearance on the podcast, Jeff, that was episode 289, to go do that. It is a great introduction to your framework, and we're going to be relying on that today to talk about this very big event that has unfolded over the last week or so, which is not the failure of Silicon Valley Bank. It's not the deposit flight from regional banks, though that is significant. It's not the new liquidity program set up by the FDIC, the Fed, and the Treasury. And it isn't speculation about a Fed pivot. It is the dramatic repricing of credit risk that we've seen in markets over the last week. Give me and my listeners your take on what we've been experiencing and why these moves have been not only significant, but literally unprecedented in certain instances.
Yeah, Demetri, I think your intuition is right. This is not just about Silicon Valley Bank. Silicon Valley Bank is sort of the most public aspect of what's been going on for some time here, which is essentially inelasticity, illiquidity across the global monetary system, which is manifested in many different ways. I mean, there are aspects of Silicon Valley Bank that we do want to pay attention to. There are certain things that have gone on there. But as you said, it's not really the huge story here. And if we look at the marketplace and really what the monetary system has been telling us for quite some time, it was basically, hey, look out, there are potholes ahead. And not just small potholes, but really major potholes ahead. So when Silicon Valley Bank came along, the market said, yeah, see, we knew something like this was going to happen. And if that was it, if it was just about Silicon Valley Bank, if it was just that Signature Bank or maybe First Republic, whatever the small regional banks are, the big regional banks that are in the news today, if the Fed was going to come in with its BTFP brand new toolkit and the FDIC and the Treasury Department were going to guarantee all depositors, that was the end of everything, we wouldn't have seen what happened this week. I think that's the most alarming thing is that all that stuff from last week's the announcement and then the weekend, maybe there's a little bit of nervousness on Monday, but it continued Monday, Tuesday, Wednesday, and even a little bit yesterday, and even again today. So as you said, the markets are reassessing the events of the last week and saying, yep, this is exactly what we expect. And because it's exactly what we expected, we expect more down the road.
So for people that aren't familiar with this, what are we talking about here? Give us some specifics about the kind of moves that we saw and also put them in historical context for us.
Yeah, the moves were just indescribable. You know, I write tons of words. I speak a lot of words, and I have very few words for what happened this week. And I don't want to be alarmist here. I don't want to say that, I don't want you people to think that the world is ending, because that's not what we're really talking about. What we're really talking about is, I like the way you framed it, Demetri, is that repricing of risk, because that's really what happened. And it repriced in such a dramatic way that it's very stark, it's very concerning, but it's not the end of the world. Things are going on, things are going in the wrong direction. So let's put it into terms. One of the markets I watch all the time and watch very closely is called Eurodollar futures, which is tied to 3-month LIBOR, or in a couple months, assuming LIBOR doesn't survive, 3-term SOFR. But essentially, short-run money market rates. What is those money market rates going to be in the future? And because it's a money market rate, because it's a key benchmark rate, and because this is a huge market, it can tell you a lot about what the monetary system itself is perceiving as what's going on either now or in the future. So Eurodollar futures, just to give you some context, any daily and on a daily basis, you won't see these contracts move by maybe more than 5, 6, 7, 8 basis points. An extreme day will be 14, 15, maybe 20. You only see more than 20 basis points moves in prices and the prices of the contract on a handful of occasions. For example, when Bear Stearns they announced that it was in trouble and failed, we had like a 20-some basis point move in most of the Eurodollar futures contract, which was a holy crap, something is going on. September 15th, 2008, the morning that Lehman Brothers was announced, we had a 40-some basis point move in Eurodollar futures. Again, prices, daily contract changes, which was a, oh crap kind of a thing. We got that again, a 40-some basis point move in a lot of these near-term contracts last Friday, March 10th, which was the day that the Silicon Valley news or the SVB news came out, which kind of makes sense because this was a sort of a confirmation. Things were going bad. Conditions were accelerating. And so, yeah, that made sense. This was a severe outbreak, something that was expected. But it was the trading on Monday that really shook me up and shook up everybody else. Was, if 40 basis points is an extreme move, on Monday in Eurodollar futures, in a couple particular contracts, a couple key contracts like September 23 and December 23, we got more than 100 basis point moves. Massive swings in the market that we've never seen any. I mean, it's double the day Lehman Brothers failed, which should give you a sense that the markets were in outright panic mode. Because what are Eurodollar futures? Eurodollar futures are essentially a hedging technique. If you're afraid that the economy is going to go into the toilet and you hold a lot of risky assets, you're going to want to hedge those risky assets because you can't sell them when the economy is going in the toilet because markets become illiquid. So you want to buy essentially economy in the toilet insurance. And that's what Eurodollar futures are. If you buy Eurodollar futures, betting that the economy is going to be bad or the market's going to be bad, liquidity is going to be bad, whatever the case may be, they're going to pay off when interest rates, money rates go down in the future. So the more that the market wants to hedge in that fashion, the more we know it's afraid of something big. And so again, Lehman Brothers, a 45 basis point swing in Eurodollar futures, that makes sense because the market was saying, holy crap, I need to hedge my assets because I'm not going to be able to sell them. If I get into some kind of liquidity trouble, I'm stuck with these things. I don't want to be. I need some kind of insurance. So Monday, March 13th, after the Fed announcement of its program, after the FDIC action, after signature SVB, all the stuff that should have been past tense, we got massive hedging, which said, again, lots of people in this deep, sophisticated marketplace were saying, holy crap, I need insurance because I don't know if I'm going to be able to sell these riskier assets. And then as bad as that was, we got a little bit of a reprieve on Tuesday, which is the normal pattern. Usually have a Friday big announcement. Saturday and Sunday, the market kind of stews about it. Monday is the continuation of Friday. And then everybody kind of pauses on Tuesday. Tuesday's the day of reassessing. So we got a little bit of a retracement on Tuesday. And then Wednesday was almost as bad. We had 60, 70 basis point moves in Eurodollar futures on Wednesday. Now, they didn't stay there for the whole day. The September 2023 contract, for example, was up about 80 basis points at one point and finished at around 30 some odd, 35, 36, I think it was. So nearly Lehman Brothers on Wednesday, after double Lehman Brothers on Monday, after equal to Lehman Brothers on Friday. So just to give you a sense, this desire, this need, this stampede into essentially catastrophic portfolio insurance continued from Friday right on through into this week.
Yeah, I mean, the move was even bigger than what we saw on 9/11.
Yeah, and two-year Treasury, that's another one, right? The two-year Treasury yield, which dropped
over 100 basis points down from where it was before this happened. The 30-year down 60 basis points, I think, roughly, right?
Insane moves in markets, daily swings that are only reserved for the worst type of circumstances. So again, don't want to panic people and say this is the end of the world, but the market is extremely concerned. And the one reason why it's extremely concerned is because it saw this coming. What happened with SVB in the wider context is simply this confirmed the suspicions that have been traded in these markets for many months now, that things were going in the wrong direction, illiquidity was building up, problems were building up, and then this happens and it's sort of like, okay, everything that we thought was wrong absolutely was wrong, but what does that mean for the future?
Yeah, ironically, this move in Treasuries probably wiped billions of dollars of losses off the balance sheet of Silicon Valley Bank.
If they had them, that's the thing. The primary reason Silicon Valley Bank was obviously they're being drained from cash from customer usage. But in response to that, and this gets us into the systemic issues here. In response to that, they made the dumbest move they could make, which was to sell all their treasuries. They sold their 20-some billion portfolio of treasuries because that's all they had. As their liquidity was being drained, as their cash cushion and cash margin disappeared, they sold the whole thing, recognizing a $1.8 billion, I think that's the loss they said, $1.8, $1.9 billion loss, which that was game over. Once the loss was reported, that started the run. But that's not the important issue here. The important issue here is, why couldn't SVB arrange other financing through repo, for example? Because that's usually what happens. You get into a cash situation where, your customers are using more deposits than you thought. You go into the wholesale markets to borrow until you can get yourself right again. Why didn't they do that? Why didn't SVB go to the Fed's primary credit window, which used to be called the discount window? Because as the Fed just reported yesterday, this week, everybody else did. We saw $85 billion taken out of the Fed's discount window, their emergency funding window. Why didn't SVB do that? So there's lots of questions here. There's lots of stuff that gives you insight into why the markets, first of all, hedged as much as they did, and why they did so, because this is not over. There's bigger issues going on here.
So what do you think that tells us, and what is it that the market is so afraid of, do you think?
Well, I think there's a combination of risk. I mean, always it starts with the economic climate, which, I mean, if the economic climate is booming, you never really see bank failures because usually there's no reason for banks to fail. There's a reason why these things always cluster together in bad economic climates, because when things start to go in the wrong direction, money providers, just regular folks who have their money exposed, they start to reassess and reevaluate what they're doing. So that's part of it. The economic climate is not as robust as everyone would like it to be, as the Federal Reserve would tell you, and ECB just did yesterday. So that's the background. But there's also structural and cyclical deficiencies in the way the monetary plumbing works. And the big one is collateral. I think that's what we need to zero in on with SVB, is because to go to the Fed's primary credit window, you've got to post collateral. So if the SVB, which was on its last legs, last resort, didn't go to the primary credit window. And yes, I know there's stigma attached, but the Fed has worked hard to try to remove that stigma, as evidenced by what we see this week. Still, why couldn't SVB go to the repo market? Why couldn't the SVB go to the primary credit window? And I think they have a dramatic collateral shortfall.
When you say they have a dramatic collateral shortfall, are you referring specifically to the haircuts they would have to take on things like treasuries and agency MBS, and that this would be too great to prevent the stemming of deposit outflow?
That's part of it. I think there's also, if you're a bank like SVB and you have most of your assets are not liquid securities like treasuries, you have a small portion of your assets in those types of securities. What you really have is a whole bunch of illiquid loans. But in a pinch, if the wholesale market is operating normally, what you could do is post those loans as collateral to a dealer to borrow U.S. treasuries or some other form of collateral that you could then take into the repo market. So essentially, you would liquefy illiquid loans through a securities transformation transaction, which happens all the time. This is not, it's regular, it's normal. It's a big part of what dealers do. So the question is, why couldn't Silicon Valley Bank do that? Why were dealers so shy about taking illiquid loans from Silicon Valley Bank and lending them U.S. treasuries that don't belong to the dealer either?
Isn't it much more difficult to value those loans in this current environment? Couldn't that be part of it?
Yeah, because that's what happens, right? So what you say is, in a normal environment where everything's fine, Silicon Valley Bank has a little bit of a cash drain, nothing too big. They go to a dealer and say, I've got $100 million in these illiquid loans. I need some treasury so I can go in the repo market and liquefy these loans. And the dealer will say, yes, I'll give you a haircut of 10%, just using round numbers. These are not realistic numbers, but just to prove our example here. So you've got $100 million in loans. The dealer gives you $90 million in treasuries. You can go in the repo market. There's another haircut of 1 or 2%. So basically you get, say, around $88 million in short-term funding from your $100 million in illiquid loans. But if you do that when conditions are normal, suddenly things start to go wrong. Dealers get a little bit risk averse. Instead of a 10% haircut on your liquid loans, they now say, I need 20% or 25%. Or in extreme cases, like we saw in 2007, 2008, they say, I don't want those liquid loans at all. So you don't have any collateral as SVB to exchange for other collateral that you could then use in the repo market, which essentially cuts you off of these marketplaces. And if you don't have collateral that you can exchange for treasuries, you can't go into repo. You certainly can't go to the Fed's primary credit window either. So your last resort is to just start fire sailing whatever assets you got that you can sell. You call in whatever loans that you can potentially liquefy, and essentially your balance sheet gets into its death spiral. And I think that's what happened. So as far as SVB goes, that makes sense. But the bigger question is, what happened that prevented them from using the wholesale emergency release? Why were dealers so against potentially transforming them and letting them give the collateral? And I think that's where we get into the systemic issues, which, by the way, one of the most extreme results of this past week was actually the 4-week T-bill rate, which is a primary collateral indication. On Wednesday, the 4-week Treasury bill rate plummeted by more than 60 basis points at one point. Again, like Eurodollar futures, we've seen these relatively regularly where collateral gets short in the early morning hours because that's when yesterday's secured financing transactions are unwound. You've got repo and derivatives. You've got to unwind yesterday's transactions. You've got collateral calls to make, all sorts of things. So when collateral is scarce, it's not unusual. It's not good, but it's become relatively common to see Treasury bill rates sink noticeably in the early morning hours, and then everything gets settled out and they go back to normal. That's usually about 1, 2, 3 basis points moves. Maybe in extreme cases, you get 4, 5, or 6. That's one that you say, uh-oh, this is trouble. We got that on Monday. Monday, there was a massive early morning scramble for collateral that was about 15 or 16 basis points, which already told you stuff was going wrong. But then on Wednesday, in the middle of the day, this wasn't even early morning, the 4-week Treasury bill yield plummeted by more than 60 basis points at one point. So if 10 basis points is a collateral run, what is 60 basis points in the middle of the day? That's a real huge problem. So again, we're back to collateral shortage, problems with all that parts of the monetary system, which probably I think relate to the systemic background, which then left SVB with no other options.
So I also want to let listeners know that we're recording this on the morning of Friday, March 17th. So when Jeff is citing Wednesdays and Mondays, he's talking about this week. Jeff, couldn't this just reflect the extreme levels of uncertainty in the market, and some significant amount of this will resolve itself and normalize after, the next few weeks pass and we get this FOMC meeting?
Yeah, I mean, you would hope that's the case, but that's never the case. And that's what I call the lesson of Bear Stearns, because that was what led into the eventual fall in 2008. After you go through this type of an event, after you see primary examples of the downside case here, I'm thinking about this in terms of individual firms, not in some systemic perspective, but as an individual firm. You run a bank. You run a bank that has a lot of portfolio. Your portfolio has a lot of assets and a lot of liabilities that look a lot like what everyone else's does, including SVB, including Bear Stearns back in the day. And what you see is that Bear Stearns back in March of 2008, and that's another factor we need to talk about, Demetri, these March bottlenecks. We can come back to that, but March of 2008, Bear Stearns was, in the words of Bill Dudley, and this is in the FOMC transcripts, Bear Stearns was a troubled but viable firm one day, and 3 days later, it was no longer viable. So what that meant is in a very short period of time, you were wiped out. And the Federal Reserve says, we rescued Bear Stearns. We shepherded it into JP Morgan's reluctant arms. We made it all happen. This was a success. When Wall Street looked at, and not really Wall Street, but banks around the world, the monetary system itself looked at Bear Stearns and said, holy crap, we could be wiped out. So from the perspective of bank managers, the downside is my equity, my money, my job, everything could be wiped out. So how did the system respond to Bear Stearns? The Fed celebrated. They said, this is great. Everything is behind us. We got this massive success that we can build on, when the entire monetary system started doing the pro-cyclical types of activities that we associate now with monetary crisis. They started to build up cash cushions because, again, as Bill Dudley said, Bear Stearns went from troubled but viable to unviable in 3 days. So firms built up cash cushion. And as firms are building up their cash cushion, they're not extending cash into the marketplace. So markets get even more illiquid. And as markets get even more illiquid, guess what firms do? They build up their cash cushion even more. It becomes this pro-cyclical self-reinforcing cycle. They began to de-risk their books. They said, okay, what is it that caused Bear Stearns to go down? Well, it was a collateral call. JP Morgan knocked on their door and said, I need $8 billion in treasuries by tomorrow. You're out of business. So I need to de-risk my book. I need to get the best quality collateral I can get available. I need to do all sorts of those kinds of things. What else do? You hedge. You hedge the hell out of what you have available. That's what happened in the wake of Bear Stearns. Building up of cash cushions, de-risking, and hedging. What have we seen already this week? Well, we've seen the hedging. We know that happened. We haven't seen the building up of cash cushions, but we can infer that that's been happening because of what's happening in this marketplace. And as far as de-risking goes, we haven't seen that yet, but it's reasonable to assume that's going on too. So again, as I said from the beginning, this was an expected outcome. And now that it's happened, now that it's confirmed everybody's fears, it's leading to all of these knock-on and second-order effects that we're going to have even more profound negative effects down the road, which is why we see this continuing process of hedging. And as you put it, Demetri, from the very beginning, repricing risk in the wake of something that was actually expected, because it's not a one-off thing. You look at what crises actually are. they're not just like the market or the whole economy or the whole marketplace just shuts down all at once and everything happens in just one-off fashion. They're actually stages. It's processes, and it's prolonged processes. And what happened this week was simply the next stage, and probably the biggest stage heading into this type of a crisis.
So this is great, because this is kind of where I wanted to get to. The Silicon Valley stuff is something that I think we covered really well in our latest episode with Stephen Kelly. So, of course, we'll have an opportunity where it's relevant to speak to that. But actually, what I really wanted to get to is how market participants, and in particular financial intermediaries who play an indispensable role in maintaining orderly markets and in the provisioning of credit and liquidity, are adjusting their risk outlook and their behavior as a result of last week's events. Because the last time you were on the podcast, Jeff, I asked you what it would take for the Fed to pivot from the policy path that it's been on over the last year, which has led to the steepest rise in short-term interest rates in over 40 years. And you said that there were two things that could cause the Fed to pivot. One potential thing would be a substantial deterioration in the unemployment data, such that the Fed might say, yeah, CPI has not really returned to target yet, but we can't afford to pay attention to that right now because this economy risks going into a tailspin and unemployment could get completely out of control. Or potentially something could, quote, break in the monetary system, causing an outbreak of deflation that leads to financial volatility, such that the Fed says, yeah, CPI hasn't really returned to target yet, but we can't afford to pay attention to that right now because the financial system risks going to a tailspin, and that would lead to a major economic recession or depression where unemployment would get completely out of control and we're back to square one again. My question for you is this what we've experienced this last week? And if not, how will we know it when we see it? In other words, how will we know what a break in the monetary system actually looks like when it happens?
Yeah, I think that's that's what the markets are telling you. You're exact. I love that this is the way you're thinking, because what we really need to do, and what I really do, is essentially interpret these market signals. What is it the monetary system is telling us that we can use as a useful real-time analysis? What the monetary system has been saying all along, going back to a long way before even the Fed started hiking rates, was that the probability that, as you just put it, one of two things was going to happen. The Fed was going to stop focusing on consumer prices and start focusing on something else. And the something else, there's really not a lot of options here. There's not a lot of things, a lot of factors that could really change the Fed's from its ultra aggressive hawkish stance to doing something completely the opposite. And okay, obviously it's not the CPI itself. The CPIs are still way too high. They're marginally improving, but certainly not enough for the Fed. So that's not the issue here. The consumer prices haven't fixed themselves just yet. Obviously, the labor market data looks really good. The unemployment rate is still near a 50-year low. So it's not that. It could be that the market is saying that the unemployment rate is going to spike in the near-term future. So that's still on the table, but that wouldn't account for what we're seeing in the market. So really, we're left with this deflationary monetary outbreak. But, as I said before, SVB, the failure, First Republic, Signature Bank, it's the tip of the iceberg kind of thing. It was, yes, this is the start of the thing that will get the Fed turned around. This is what we're waiting for. And now that it's happened, the chances of the Fed turning around are not just near, nothing's ever for certain, but it's as near certain in the market as anything could ever be. And not only that, we're seeing the market start to signal that this turning around in the Fed, because of this thing, is closer than many people would like. The Eurodollar futures curve is inverted all the way to the front. So the April contract is the first contract, and it is priced below the May as well as the June contract, which is saying the market is not certain, but there's a reasonable expectation that the first rate cut happens in the next couple months. And then once the first rate cut happens, it's going to be a series of rate cuts in quick succession. So what is it that gets the Fed to, first of all, stop hiking rates? Because, the ECB hiked rates yesterday.
50 basis points, yeah.
Yeah, so the ECB said, we're not worried about anything. It's likely the Fed shares the same near-term view. So the next week the Fed gets together, they say 25 basis points probably. just to kind of split the middle there. But after that, what is it that stops the Fed and gets them into aggressive series of rate cuts? It's not Silicon Valley Bank. That's not it. And the market is hedging so persistently for this scenario, as it has been all along, we're left with very few conclusions. So really, it's a combination of these two things, because if we do have this monetary event that continues to go beyond the regional US banks into other banks around the world, today's March 17th, China just announced an RRR cut, which is essentially saying we're a little bit worried about the global monetary system here. So if this continues to go and spread, yes, you'll have financial volatility, but it'll also lead to a sharp rise in unemployment, which will then, at that point, the Fed will have absolutely no choice but to do exactly what the markets are pricing right now.
I was worried I was going to trigger you by bringing up the Fed and implying that somehow it mattered or its decision on Wednesday mattered. I'm happy to see that there's some room to explore this. On that point, specific question, what do you think the likelihood is of a 50 basis point hike?
I think that's probably zero.
So let me tell you what I was thinking about it. And this is not necessarily your expertise, but whatever. We've all been forced to become tea leaf readers. I wonder if the same forces that have conspired to assault our ability to come to agreement on various social or political issues and form a consensus view of reality are making forward guidance in the monetary policy realm, which I would argue has been the primary tool of central bank policy for the last decade at least, useless. Because we've seen this multiple times during this cycle where Jay Powell has come out, given a speech, and clearly the reaction of markets has not been what he wanted it to be. And he's had to come out again and again and revise the market's expectations through more statements, through articles published by the Wall Street Journal's Nick Timiraos, and via other members of the FOMC who hem and haw and try to get the market to understand what Jay Powell seems to be intending, to leap this explanatory chasm, in other words. And I wonder if, just like with Paul Volcker's Saturday Night Massacre in 1979, if we aren't seeing a potentially similar setup here today, where Powell uses this opportunity to raise, in this case, 50 basis points, if the market doesn't get the message, in order to stamp out once and for all inflation, even if the inflation we're seeing is not a demand-driven phenomenon, because he's not concerned about financial stability because of these liquidity facilities like the Bank Term Funding Program, and because he can use the balance sheet to ensure financial stability.
Yeah, they're crazy enough to try something like that. I think that's the Fed doesn't understand the monetary system. It doesn't even understand financials. It thinks lower interest rates are actually stimulus when it's actually the opposite, as we're seeing right now. Inverted yield curves are the exact opposite of loosening financial conditions, but yet every time long-term yields fall because growth and inflation expectations do, they say that we don't like the market loosening it. So yes, there is definitely an impulse or an undercurrent from the FOMC trying to tame the marketplace. What the marketplace is saying is, you're all wrong. You've got this entirely wrong. You've got it completely, utterly wrong. We're betting against you. It's not that we need to be tamed, it's that we don't agree with everything that you're saying. That's why the curves are inverted as much as they are. And everything that's happened this week is consistent with markets have been saying. And what they're now saying is, yes, we've heard all about the Fed's reaction function for the last year. And I agree with you, Demetri. I think Paul Volcker poser, Jay Powell, has intended to try to shock the markets out of what he thinks are loosening financial conditions, which are actually tightening financial conditions. And so, yes, there may be a chance next week that he does a 50 basis points just to try to stay consistently with his idea. And I think that's been discounted in the marketplace too. So maybe there is a 50 basis point rate hike, but that still doesn't change the near-term scenario. At some point, as hawkish and as Paul Volcker-esque as Jay Powell wants to be, the markets are saying we are near to certain, just as we were near to certain something like this was going to happen, we're even more near to certain now something bigger is going to happen. Because at that point, if we do get something really big that's really disruptive, there's absolutely no way the FOMC is going to be, Jay Powell's not going to be able to come on TV as stock markets are plummeting and say, well, you know what, we're going to hike rates some more. That's just not going to happen. And I think there's also the other politics here, We all know one of the reasons why the Fed got so Volcker-esque last year was because of the political pressure put on the Fed. And so if consumer prices are everything that politicians are talking about to get the Fed to move as aggressively as it did, then what happens if consumer prices are no longer the topic of discussion all across the internet and the news media in the public discourse? We're instead talking about, oh my God, the unemployment rate's on its way to 10% or something like that. I'm being hyperbolic for a reason. Then the political pressure does a completely 180-degree turn either way. So I don't disagree with your premise, Demetri. I think that's exactly what the Fed wants to do. The question always is, will the Fed be able to do it? This is the conundrum that Alan Greenspan described, 18 years ago in February 2005. He was saying, I'm going to do this. And the market was saying, we don't believe you're going to be able to. And so that's what the market is right now in an even more extreme case. We hear you, Jay. We've heard you all year talk about your reaction function and how you want to be hawkish, you want to be Paul Volcker. We don't believe you ever get to finish that trend that you started. We think that events are going to overtake the Fed at some point. That's always been the only independent variable here, was when, not the what. The what has been consistently priced all along. It was always the when. And as I said, last year when the Eurodollar futures curve was inverted to the December 22 contract, this was mid-year last year amidst stuff that was going on then. What that said was that there was a good chance the Fed was going to do this turnaround in 2022, toward the end of last year into the start of this year. Well, as it's turning out, it only missed by a couple months. So again, the market is seeing confirmation about everything that's happening. And as it's being confirmed, that's part of the equation. It's not what the Fed wants to do. It's what the Fed will be able to do over enough time where even reality has to enter the FOMC boardroom.
So you said this isn't 2008. It's like 2008-like, kind of flesh that out for me. What do you mean? How is it like or not like 2008? And maybe how are people getting some of the analogies wrong here?
Yeah, that's a really good point because history, doesn't repeat exactly. I mean, we go through these processes, these cycles that look similar, but they're never exactly the same. So no, I don't think we're going to see another Bear Stearns. We're not going to see another Lehman Brothers. I would not put SVB on the same level as Bear Stearns. I think it's the same type of a thing, the same type of reminder, but we don't have the same individual circumstances that are contributing to that type of a thing. I think the big banks around the world are mostly fine, which is one of the things that we didn't see this week. It was a sharp jump in LIBOR because most of the dealer banks themselves are fine, but themselves being fine can still leave everybody else in a big position. So if 2008 was, in terms of the monetary system and banking system, about these securities firms like Morgan Stanley, Lehman Brothers, AIG, we're not going to see the same thing this time. We're going to see other types of firms, even countries, have funding difficulties. So JP Morgan's going to be fine. You're not going to see a bailout of Citigroup. Credit Suisse is probably the exception that proves the rule here. But you're not going to have those types of big bank failures. It'll be more, in some ways, more insidious because it will be hidden. It's not the big firms that we've come to know and watch. It's these other ones that just pop up out of nowhere. So I think that's the major difference. And where there are similarities, we're in the big picture terms. What made 2008 into its own sort of brand? I mean, you just use the term. You just say 2008, people immediately know what you're talking about. And the reason isn't because of Lehman Brothers. It was because Lehman Brothers represented an extreme outbreak of deflationary money that pummeled an economy that was already in trouble. It was the combination of inelasticity, basically, traditional depression mechanics. You had a bout of inelasticity that was severe and global, an economy that was already in rough shape. Those two things together produced the worst type of economic circumstance. And that's why we remember it. Compared to other periods where we get a recession like in 2001, hardly anybody remembers the recession in 2001. They remember September 11th, but they don't remember the recession. In fact, if you do remember the recession, they think it had to do with September 11th. Whereas in 2008, it was the combination of those two things. And I think that's what's driving the hedging. That's what's driving everything into 2023, is that we have the same scenario, general scenario. We've got an outbreak of inelasticity and deflationary money. We've got an economy that is globally much weaker than people wanted to believe. I think a recession might have even started last year.
You also have a major war that's going on in Ukraine.
Not to mention, you're exactly right. We've got lingering supply problems. We've got food prices. We've got negative factors everywhere. So you put all of these things together in one pot, and it's a 2008-like mix. The danger, the downside is that severe, which is why we've seen hedging and repricing of credit that bad, because it's the same type scenario, even if it's not a repeat of 2008.
That's severe in what sense? Because the 2008 crisis was a systemic liquidity and solvency crisis that hit the big investment banks, who are collectively sitting on hundreds of billions, if not trillions of dollars of illiquid CDOs. That's not what we have here. What we have here is potentially a regional banking crisis driven by deposit outflows and non-performing loans to parts of the economy like commercial real estate that are under stress, private equity, which is also affected by a rising rate environment. And you mentioned there are countries like Sri Lanka and Pakistan that are especially vulnerable. So what are the areas that you feel like we should be most concerned about here?
All of the above. I mean, no, you take it from individual pieces, individual cases. The issue with depositors is, I think, primarily about how many really wealthy individuals had uninsured deposits. And I think that's what really made a big deal at Silicon Valley Bank specifically, was that as the bank started to become more and more troubled, as it started to publicize its troubles through, trying to raise capital and other things, trying to rectify its liquidity situation, those who have uninsured deposits said, I need to move my deposits, because if this bank goes under, I'm an unsecured creditor, which means who knows what. So there's the issue of uninsured deposits, this is always in the background anyway. It was slightly in the background of 2008, though. It didn't really become a big issue then. I'm not sure that's the biggest concern here. I'm not saying it's not a concern, because it's going to be a concern for certain people and certain banks that are overexposed to that type of funding. To me, the more interesting question, as it was in 2008, is the systemic breakdown, because what happens is this is not like the old days. A bank run is not like it used to be in the 1930s. A bank run used to mean currency moves from the banking system to the public. The public starts to hold and hoard currency, which
Physical
deprives
notes.
the banking system of its ability to operate. That's what liquidity meant. Liquidity meant you have currency in a vault that you could exchange for either loan assets, or if your customers need it, you can deliver them that kind of liquidity. So a bank run was when currency moved from the banking system to the public. That's not what we have today. We have a virtual ledger money system where if I take my money out of the bank, I don't take any money out of the bank. What do? I go to another bank I do like, I set up an electronic account, and I set up an electronic transfer. So a bank run nowadays is where cash, which is virtual cash, is not actual cash, migrates through book entry from weaker firms to stronger firms. Now that happens all the time. And it's these wholesale markets that are in place to redistribute that cash back where it's needed. So we have essentially, over the last year, regional banks have been drained of their cash for a variety of reasons, including their customers using it. So they've been drained of their cash, but that cash doesn't disappear. It's not being hoarded by the public because it's virtual cash. It's migrating toward the bigger firms. And the more interesting systemic question is, what is preventing the bigger firms who have all this cash from redistributing it back to the smaller firms who need it? Not only do they need it, they really need it over the last week. So there are systemic issue here. And I think a lot of it is about shortfalls in collateral, the inability to liquefy illiquid assets in these portfolios to make them usable in these emergency types of situations. So like Silicon Valley Bank, normally it could take a bunch of its illiquid loans, go to JP Morgan or Goldman Sachs and say, I want to borrow some treasuries. But Goldman Sachs is saying, you want to borrow the treasuries, I'm not going to lend them to you. Why? What is going on there? That hints at other factors beyond just Silicon Valley Bank.
Let's dig into that a little bit. Hold on. So what is it that you think the Fed is missing that's preventing these larger firms who have the cash from redistributing it to smaller firms? Why are they hoarding collateral? Is it the scale of the economic contraction that they're concerned about, that the Fed is not appreciating? And if so, what kind of economic downturn are we looking at here?
Well, taking the second part first, how bad is it going to get? That's where we look at the markets, we look at the curves. The curves have said, they've warned all this time this was a big risk. And everything that has happened along the way has only confirmed these suspicions. So where are the curves right now? The curves are in the process of doing the bad steepening, which is where short-term rates go down faster than longer-term rates, which is the absolute worst thing you want to see, because that means that this thing that we've been afraid of all the time, it has already begun. So the market's place is saying everything that we thought was going to happen has actually happened, and now it's actually started. The thing that we're worried about has started. So how bad can things get? I mean, you look around at what happened in the last week and you see some of these occurrences, some of these instances, some of these transactions, daily moves, volatility. I know people in the stock market are thinking this is no big deal, but in these deep credit and monetary system, it was a gigantic earthquake, which again, we don't associate these with just normal problems. This is 2020 stuff. This is 2008 stuff. This is the 1970s kind of stuff. So as far as the downside case goes, it's pretty far down. Again, it's not the end of the world. It's not like society's going to collapse. It's not going to be like 1930 and 31, but that doesn't mean we're not in for a very, very rough ride ahead. Now, as far as how we're getting there, it really all comes down to how the monetary system works. And it's not really about interest rates, in my view. It's about risk aversion amongst those who actually do provide elasticity in the monetary system. That's these money dealer banks. And that's why I keep coming back to the most interesting question is why aren't they doing the job that we need them to do? And that includes collateral redistribution. As I said, Silicon Valley Bank or any regional bank usually goes to a dealer and says, I need you to transform my illiquid loans into some usable collateral. And usually the dealer says that's no problem. But the dealer does undertake some risk in that situation. So if the dealers are becoming risk averse, and we'll get to reasons why that might be, but if the dealers are becoming risk averse, it has nothing to do with the interest rates. If the dealers are becoming risk averse, they're going to not want to do their dealer activities. And we've seen extreme examples of this that have nothing to do with interest rates, like September 2019. The interest rate on repo got extremely high, which should have enticed dealers to move into the marketplace. Instead, they said, oh, something's really going on here. I'm going to pull my stuff out. That's the type of behavior that we see repeatedly in these financial crises. The money dealers who create currency and liquidity and elasticity, when they're confronted with these types of situations, again, the lesson of Bear Stearns, they add their own cash cushions. They de-risk, they hedge. And if the money dealers are hedging and de-risking, it leaves everybody else exposed to problems in the system, which brings us back to what is it that dealers are so afraid of that they're de-risking and leaving the entire monetary system exposed to these types of events? And that's a number of things, including problems in their own books. It's economic outcomes. It's looking at the economy and saying, China's not looking all that great. Global trade's already collapsing in Asia. There's a number of reasons why dealers would become risk averse that I don't think we need to bring the Fed into it. And as dealers become risk averse, as I said before, it gets into this self-reinforcing downward spiral because they become risk averse. The currency system starts to become inelastic, liquidity drops, it has harmful effects on the economy, which only proves the suspicion that dealers had in the first place. They say, aha, everything that we were afraid of has happened. They start to pull more of their balance sheet back, become even more risk averse, and round and round and round we go. And every step and stage in the crisis merely serves to confirm the worst fears, which contributes to the next stage down the road. So SVB, what happened in the last week, is a prominent stage in that crisis, which is confirming to dealers what they've been worried about all along, which means they're going to be doing, like they did in the wake of Bear Stearns, all of the things we don't want them to do. And it has, again, regardless of what Jay Powell does with interest rates, the consequences have already been set in motion.
Yeah, so you mentioned these liquidity bottlenecks. March is one and September is one. I wonder if what we're just going to end up seeing here is the expansion of lending through this new term funding program and increasingly new emergency facilities to continue to try and liquefy markets.
That's what they're left doing, because at the end of the day, they're not really a central bank. The Fed's not a central bank in the classical sense, where Walter Bagehot said, lend freely at high rates at good collateral. That's not what the Fed actually does. What the Fed tries to do is, they actually admit this. They try to be a market of last resort, because what they're saying is, like Silicon Valley Bank, when the monetary system, when all these dealers start to contract, when inelasticity grows and illiquidity, all that bad stuff happens, what happens to the individual firms? When they can't borrow in repo, when they're stuck, they have no other options, they have to start fire sailing their assets. And as those assets start to be sold in the marketplace, it leads to even more second order effects where the markets themselves become illiquid and everybody else has to fire sale more because prices go down in uncontrolled fashion. So what the Fed says, what a classical central bank should do is come in at the beginning and interrupt that process before it even begins, because they'll say, we're going to step into the monetary system before it becomes inelastic at any point. But the Fed can't do that. The Fed is not a central bank. So it tries to come in at the end and say, well, we'll liquefy these markets so that these fire sales don't turn into self-reinforcing spirals. And that's what the BTFP is actually about. That's what FEMA was about in March of 2020. That's what the PDCF was in 2008. But as you'll note, as the Fed comes out with these four-letter programs all the time, they don't work. They don't lead to a resolution of the crisis. The Fed introduced the PDCF in the wake of Bear Stearns. And all summer, you read the transcripts from the FOMC, they said this PDCF is genius. It's going to prevent any type of crisis. Then Lehman Brothers hit, and guess what? We had the worst one since the Great Depression. They introduced another one, the Term Securities Lending Facility, just before Bear Stearns failed. That didn't work either. So the Fed comes out with all of these new tools that don't prevent a crisis from happening. You can argue, as the Fed actually does, when you hear what they're saying, we were effective not in preventing the crisis, but in limiting their downside. That's a very different set of circumstances than what people imagine. And it's not a central bank. But so the real thing here, these four-letter tools, they're not liquidity tools. Ben Bernanke said this. He let the cat out of the bag in March, and I think it was March of 2015, his first blog post at Brookings. He said, when I was at the Fed, I reminded everybody that our job is 98% talk, and that the most valuable tool that we have in our toolkit is not these four-letter stuff that we can continue to bring up. It is that talk. If you believe that the Fed's BTFP will be effective, even though you have no idea what it is, no idea how it works, if you're comforted by the Fed doing something, then the Fed believes that your comfort will lead to it will help the situation, because positive emotions and optimism they always come back to emotion.
Yeah, unfortunately, that bullshit doesn't work anymore.
And it didn't.
Just like forward guidance doesn't work anymore.
But that's the thing, Demetri. That's what the Fed offers. Ben Bernanke was right.
It worked to some degree in 2008. It worked to some degree in 2012 when Mario Draghi gave his whatever it takes speech. I think that we're in a new paradigm now, and that's sort of what I was getting at when I mentioned the inefficacy of forward guidance and all of these revisory press conferences that Jay Powell has had to give, and sending out all the other FOMC members to talk, or Nick Timiraos to write an article, because the market just doesn't get it, because that transmission mechanism is broken. Jeff, I'm going to move the rest of our conversation onto the premium feed. I want to switch gears a bit in the second hour and kind of look big picture at what the system ends up looking like coming out the other end of whatever this is that we're going through right now, because it feels like we've been living the last 13 or 14 years in this period of suspended animation post Great Financial Crisis. And now we're kind of back to dealing with the underlying problems that were never really resolved. Only those problems are now bigger and implicate the efficacy of the monetary system itself, the role of the dollar as a global reserve currency, and the bond market of developed economies like the UK and Japan, at the same time as we're dealing with an open-ended proxy war against Russia and Ukraine, and what feels like the footsteps of a new Cold War with China that could eventually remake the global security environment. For anyone new to the program, Hidden Forces is listener-supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Jeff, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Jeff, stick around. We're going to move the second hour of our conversation onto the premium feed.
All right, can't wait.
If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.